Welcome back to the Deep Dive. Today, we're plunging into the U.S. stock market. Definitely a topic on a lot of minds, especially with, so much uncertainty swirling around. We've just absorbed this, comprehensive daily intelligence brief. It's packed with multi-layered analysis and a pretty sharp action plan, all geared towards understanding market moves the next, say, 24 to 48 hours.
Yeah, it's a really dense piece of work.
It is. And it's fascinating just seeing how they try to unravel these really complex market signals.
Indeed.
Yeah.
And our mission here for this deep dive is really to distill the crucial insights from all that material. We want to help you not just navigate, but truly understand the conflicting signals that are in play right now.
Okay.
Think of it as like your shortcut to being deeply informed, designed so you walk away with genuinely actionable takeaways and maybe, hopefully, some real aha moments.
All right, let's unpack this then. Our source jumps right in, highlighting what it calls a significant reassessment of macroeconomic priors. Now, that sounds pretty heavy.
It is.
How does this new understanding, fundamentally change the market's current mindset? Especially with the Federal Open Market Committee, the FOMC, meeting just around the corner.
Well, what's fascinating here is how the analysis uses something like real-time Bayesian inference. Basically, the market had this strong prior belief, right, heavily influenced by past Fed talk, that inflation was, somewhat elevated and policy would stay restrictive, Fed funds rate stable. But then, like you said, new evidence just dropped, the May CPI report.
Consumer Price Index, yeah.
And it came in, significantly cooler than expected.
Okay, so what were the critical numbers, the ones that really forced this recalculation?
Right, so headline CPI rose 2.4% year over year. That was below the 2.5% forecast.
Okay.
Month over month, it was up just 0.1%. Again, below the 0.2% people were looking for. But the real kicker was core CPI.
Right, excluding food and energy.
Exactly. That rose a mere 0.1% month over month. The forecast was 0.3%. So that's not just a little miss. It really shifts the whole debate.
From if inflation is cooling to how quickly, kind of.
Precisely. It forces the market to reevaluate pretty much every assumption about what the Fed might do next.
So even though annual core inflation is still a bit sticky at 2.8%, still above the Fed's 2% target.
Yeah, still high.
This cooler print, it fundamentally weakens the argument for a more hawkish Fed, right? It lowers the odds of that higher for longer story.
Definitely.
And pushes probabilities towards maybe a more neutral, perhaps even slightly dovish policy tilt.
That's exactly it. The market is effectively caught between this downward trend in the latest data and the still high absolute level of inflation. That creates this immediate tension we're seeing.
Okay, so here's where it gets really interesting for like the next day or two. Given these conflicting signals, you've got the dovish CPI report bumping up against a Fed that's been pretty cautious historically. Our source outlines 3 probabilistic scenarios for the FOMC meeting on June 17th and 18th. What's the highest probability one, and what would that mean for us?
So the source gives the highest probability, 50%, to scenario B, dovish leaning neutral.
Okay, 50%.
Yeah. In this outcome, the Fed holds rates steady, but, and this is critical, it explicitly acknowledges progress on inflation, probably references that softer May CPI report directly.
Right.
The tone would be balanced, not committing firmly to future cuts, but definitely signaling more confidence in their current policy stance. This scenario feels most likely because, it lets the Fed react to the new data without painting themselves into a corner, keeps their options open.
Makes sense. And if that happens, what's the market likely to do?
It would probably trigger a relief rally. Equities up, Nasdaq 100, tech stocks likely leading the way.
Yeah.
Treasury yields would probably drift lower, and the U.S. dollar would weaken a bit, reflecting those easing rate expectations.
Okay, what about the more cautious approach? Scenario A, the hawkish hold. Our source puts that at 35% probability. How does that look?
Right, scenario A, hawkish hold. Here, the Fed also keeps rates steady, but the rhetoric, the language they use, would be different. It would emphasize that core inflation at 2.8% is, not defeated.
Still too high.
Exactly. They'd probably highlight persistent inflation in services that actually rose 3.6% over the last 12 months. So the message would be one of, resolute patience, pushing back hard against any hopes for immediate rate cuts.
So this Fed would basically ignore the latest CPI print, treat it like a one-off.
Pretty much, yeah. Or at least downplay it significantly.
And what would that kind of message do to the market?
That would likely be negative for stocks, especially those rate-sensitive sectors, tech, consumer discretionary. The U.S. dollar would strengthen, Treasury yields would likely pop higher as that higher for longer idea comes roaring back.
Oof, okay. And then there's the long shot, only 5% probability. Scenario C, unexpected dovish pivot. What would it take for the Fed to make such a, well, surprising move?
Yeah, this would be a big surprise. It would mean the Fed delivers just a remarkably dovish message, maybe even hinting strongly that a rate cut in July or September is now actually on the table.
Wow.
Yeah, it would be a significant, almost startling shift from their recent cautious stance. They'd effectively be admitting inflation is cooling faster than they thought.
And that, I imagine, would be sharply bullish for equities.
Oh, absolutely. Broad-based rally, significant drop in Treasury yields, sharp U.S. dollar decline, fireworks, basically.
Okay. So as the market is trying to digest these potential outcomes, how are the major indices and sectors reacting right now, pre-FOMC, what's already priced in?
That's a really important question, right? What's priced in? Well, the S&P 500 is kind of stuck in this consolidative pattern. It reflects this uncertainty perfectly.
Sideways.
Yeah. The Nasdaq 100 being the most sensitive to rate expectations, it showed some nervousness. And the Dow, well, it continues to underperform the others, mostly because of its value tilt, less exposure to the whole AI thing. But what's really fascinating is the sector performance. Energy was actually a top performer recently. Names like Halliburton, ExxonMobil were up quite a bit.
Interesting. Hedging against inflation, maybe.
That's what it suggests, yeah. Some investors hedging against maybe a hawkish Fed or inflation sticking around. But at the same time, defensive sectors like consumer staples and financials, they were among the worst performers.
So it's all over the place.
Exactly. It indicates a really fractured risk appetite. Investors are struggling to find a clear direction before the Fed speaks.
It really sounds like the market's walking a tightrope. Okay, so we've navigated these broader market currents. But then our source drills down, right? Shows how these big macro forces are playing out in specific stock stories, often creating these intriguing internal conflicts.
That's right. And instead of just reacting to the headlines, the source applied what it calls first principles thinking to pick these 5 stocks.
Right,
which means, stripping away the noise, looking at the fundamental drivers, the core conflicts at play, trying to see beyond the daily news churn.
And using that Bayesian thinking again.
Yep, using that Bayesian approach to try and resolve these inherent conflicts, at least for the immediate, 24-hour window. Helping you understand not just what's happening, but why it matters and what the most likely immediate outcome might be.
Okay, let's dive in. First up, NVIDIA. NVDA. I mean, it's truly the epicenter of the AI narrative, isn't it?
Absolutely.
Trading at just a staggering $3.54 trillion valuation, PE of 57. So is this sustainable? Or is the momentum just too strong to ignore right now?
Well, the conflict is crystal clear, isn't it? That valuation is, historically speaking, stretched, way stretched.
Yeah.
Yet its price momentum and, crucially, the institutional buying flow, exceptionally strong. Our source highlights incredibly aggressive bullish bets in the options market for NVIDIA, sophisticated players making huge wagers on continued upside.
So what does that level of options activity really tell us about where the, let's say, smart money expects NVIDIA to go in the immediate term? Why is that so significant?
Well, it suggests a really high conviction in short-term upside, right? Some players might even be incentivized to push the price higher to cash in on those calls.
Okay.
Our AI simulation predicts, interestingly, a sharp, though maybe brief drop if the Fed comes out hawkish. But if the Fed is dovish, a breakout to new all-time highs, potentially triggering what's called a gamma squeeze.
Right, that rapid surge from options hedging.
Exactly. So for the next 24 hours, momentum looks like the dominant force here. Unless the Fed is extremely aggressive, that underlying bullish flow is likely just going to absorb any initial dip.
So NVIDIA's immediate future is basically a direct barometer of the market's Fed reaction.
Got it. Okay, let's pivot. Apple, AAPL, post-WWDC. Is Apple Intelligence this transformative growth driver, or is it just necessary catch-up? The market's definitely chewing on this one.
Here, the conflict is between the short-term technicals and the fundamental bullishness.
Yeah. Technical indicators, looking at an hourly chart, they actually show strong sell signals.
Yeah.
You've got a bearish MACD, price below key moving averages, not pretty short-term. Yet, post-WWDC, you have Major analysts, Wedbush, Evercore ISI, Bank of America, they've all reiterated buy ratings. They've raised price targets, some as high as $270.
Wow, okay.
Plus, short interest is really low, 0.63%. That's generally bullish. So our AI simulation shows the technical sellers dominating in the very short term, but those fundamental buyers, they're creating a strong support floor underneath.
So how does that conflict resolve?
It kind of resolves into this dip and bounce scenario. The bearish technicals will likely drive a near-term test of support, maybe a little wobble, but that bullish fundamental backdrop should prevent a major breakdown, which, might make that dip an attractive entry point for some.
Interesting. Okay, moving from the tech giants to maybe a surprising consumer bellwether, Sprouts Farmers Market, SFM. This stock has had just incredible momentum, right up over 108% in the last year.
Incredible run, yeah.
Can it keep that up? Especially given the broader economic signals we were just talking about, that shift in macro priors.
Right. That's the core conflict for SFM. It's got this powerful individual stock momentum just slamming up against these emerging macro headwinds.
Okay.
Technically, it looks strong, and it has notable short interest, about 7.6% of the float. That could potentially fuel a short squeeze if things go right.
Wow.
However, as a consumer-facing stock, it's particularly vulnerable to any broader economic softness. And that weak Lennar earnings report we touched on, that really highlights the risk.
Right, the housing market signal.
Exactly. So our AI simulation suggests it's kind of a battleground scenario for SFM.
Yeah.
The most likely outcome, increased volatility, choppiness. While its underlying trend is strong, the risk of a sharp pullback has definitely increased in the last 24 hours because of these macro worries.
Okay, battleground stock. Got it. Another fascinating case our source dissects, Interactive Brokers, IBKR. Their whole business is tied to market activity, volatility. But it's been down over 5% recently. So is that a warning sign? Or maybe an opportunity that people are missing?
Yeah, this is a classic conflict, isn't it? The stock's shown recent price weakness, sure, but the upcoming FOMC decision, it's almost certainly expected to increase market volatility.
Which is good for them.
Which fundamentally benefits IBKR's business model. More trading commissions, better net interest income potentially. Analyst consensus is actually a moderate buy.
Okay.
Our AI simulations suggest that sophisticated traders are likely anticipating that post-FOMC volatility surge, and they might position themselves in IBKR as a kind of volatility play.
So the resolution.
The recent weakness looks more like a buying opportunity. The anticipation of that volatility catalyst should, theoretically, override the short-term negative price action.
Makes sense. Okay,
yeah.
Finally, we have to talk about GameStop.
Yeah.
GME, the quintessential meme stock.
Oh, yeah.
Almost entirely divorced from fundamentals, right? Driven by Reddit, Wall Street bets, high short interest. How does the source even make sense of this?
Well, for GME, the conflict is the thesis. That's the whole story.
Right.
It's driven by this powerful retail sentiment, the mechanics of a potential short squeeze, all completely opposing its, frankly, weak business fundamentals and the strong sell ratings from analysts.
Yeah.
Short interest is very high, 11.6% of the float, and the options activity is extremely bullish, a very low put-call ratio of 0.40. That just shows this massive speculative appetite for calls, for upside bets.
So what does the AI simulation say? Trained on Reddit mentions, no less.
It predicts a potential cascade effect, right? If some new sentiment catalyst emerges, a tweet, a post, whatever, it could lead to a parabolic squeeze. So the outcome for GME in the next 24 hours, it's almost entirely dependent on whether a new coordinated sentiment catalyst pops up.
So without one, it just drifts?
Likely drifts, yeah. But with one,
Okay.
could see another one of those crazy parabolic moves. It's basically a bet on that catalyst emerging, and the market is definitely pricing in a higher than normal chance of that happening.
That disconnect is just... it's really something else, a unique dynamic.
Totally unique.
And speaking of broader market phenomena, our source also flags some important second and third order effects that are shaping the bigger picture, beyond just these individual stocks.
Yeah.
What's the first major one saying?
Right. First, there's what the source calls the Lennar contagion risk, that weak earnings report from Lennar Corp, the home builder. It's way more than just one stock missing estimates.
Okay.
So the first order effect is obviously Lennar stock price falls. But the second order effect is the negative signal it sends about the health of the U.S. consumer, the housing market overall.
Because they explicitly mention.
They explicitly cited softer market conditions and needing incentives for affordability. That strongly suggests consumer balance sheets are strained. And that creates a significant headwind for the whole consumer discretionary sector.
And third order effect of that.
is the significant bifurcation we're seeing. The AI-driven rally, like with NVIDIA, seems almost completely disconnected from this emerging consumer weakness. And that divergence, well, it feels unstable long term. It even suggests the potential strategy, like a pair trade, going long a market leader like NVDA, while shorting a vulnerable consumer-facing name.
Wow. It really makes you think, doesn't it? How quickly the market narrative can pivot on just one data point, but these deeper issues might still be lurking.
Absolutely. And then there's the second major point, the valuation alarm bell.
Okay.
So while the S&P 500 and Nasdaq are hitting or near all-time highs, our source points to some underlying signals of, well, extreme caution. Corporate insiders, for instance, are reportedly selling shares at the fastest pace in months.
Not usually a great sign.
Not usually, no. And the Buffett indicator, that's the total stock market cap relative to GDP, it's at 198%. That's a level historically associated with pretty significant overvaluation.
So what the source is highlighting here is that while the headlines are all about new highs, these underlying signals, like insider selling, the Buffett indicator, they suggest the market's current climb might be built on, let's say, thinner ice than many realize.
Exactly. A growing disconnect between price and maybe fundamental value
And the third order effect there.
is that the current rally might be fragile, susceptible to a sharp, sudden decline, what the source calls an air pocket.
Oof.
Yeah. And this just elevates the strategic importance of understanding these potential bearish scenarios and, practically speaking, why it's crucial to use tightly managed stop losses.
Which raises that really important question, doesn't it? How do these deeper insights influence how you, listening right now, might think about managing your own portfolio?
It's about combining that really precise microanalysis of individual stocks with this keen awareness of these larger, sometimes kind of hidden market forces. Understanding these opposing viewpoints, connecting the dots, that's where the true value really lies, I think.
What a deep dive. Seriously. We've navigated some really intricate signals in the stock market today, from the macro shifts driven by inflation data and Fed policy, all the way down to the unique forces shaping individual stocks like NVIDIA and, well, GameStop. It's clear that while the market throws up a lot of conflicting viewpoints, understanding these underlying dynamics really does provide a powerful advantage for you.
Yeah, and our goal is always to try and provide you with those aha moments, helping you not just absorb the information, but truly grasp its implications, because knowledge, when it's really understood and applied, that's truly valuable.
Absolutely. For the fastest and most frequent updates on this kind of analysis, make sure you subscribe to the Deep Dive.
Please do.
And as you go about your week, maybe consider this provocative thought. Given the market's current complex signals, you've got consumer weakness maybe showing up, but AI highs still roaring. How might you rethink your own approach to evaluating risk and opportunity beyond just the headlines? Something to chew on. Until next time, stay curious.